Hi everyone, and welcome to ACCA P4 Advanced Financial Management. We're going to pick it from where we stopped last week. Last week we started calculating NPV, internal rate of return, and the discounted payback. We looked at inflation. We also looked at capital allowances, and we looked at situation where capital allowance might be claimed in advance, which is from year 0, and capital allowance might be claimed in arrears. So we are going to pick it from NPV and internal rate of return compared. Okay, as we saw last week, as long as the NPV is positive, it means the internal rate of return is greater than cost of capital. And as long as NPV is negative, internal rate of return will be less than the cost of capital. So let me illustrate this. Okay, so if my NPV is positive, it means that internal rate of return is greater than the cost of capital, and we will say the project should be acceptable. If the NPV is negative, it means internal rate of return is less than cost of capital, and we will say we would have to reject it. So when we have only one project and the NPV of the project is positive and is saying the project should be financially acceptable, obviously internal rate of return will also say the project should be financially acceptable. So what we are trying to say here is that where there is a project, if NPV says the project should be financially acceptable, internal rate of return will also say the project should be financially acceptable. And this is what we are discussing here. So when there is a single project, there is no going to be a conflict between NPV and internal rate of return. All of them will give the same word conclusion as to whether the project should be financially acceptable or not. However, where there are mutually exclusive projects, question here is, what is a mutually exclusive project? Mutually exclusive projects are those projects that you cannot undertake all of them at the same time. So for instance, if I say project A and project B are mutually exclusive, then I can either take project A or I can take only what? Project B. I cannot undertake all the two projects at the same time. When we find ourselves in a mutually exclusive project where we would have to find one or select one of the project, that is where there might be a conflict between NPV and internal rate of return. So let's illustrate this. Okay, so when we come here, you look at these two projects, project A and project B. Okay, project A NPV is 610, B NPV is 1026, internal rate of return 20% and 18% respectively. Let's assume that cost of capital of the company is, let's say, 10%. If I pick project A on its own, NPV of project A is positive, which is indicating the project is financially acceptable. If I pick project A, its internal rate of return is more than the cost of capital, which is also saying the project is financially acceptable. When I come to B on its own, NPV is positive, internal rate of return is greater than the cost of capital. Therefore, B2 is worth undertaking. The question here is, A and B are mutually exclusive. I cannot take A at the same time take B. On their individual levels, each of them is brilliant, is financially worthwhile for us to undertake. But because they are mutually exclusive, you cannot do all of them. You would have to select one. Which one should you select? That is where there is a conflict between NPV and internal rate of return with respect to which project should be undertaken. So if I have to select on the basis of NPV MPV would have said select project B. If I have to select on the basis of internal rate of return, it will say select project A. There is a conflict. We can only undertake one at a time. We can't do all of them. Which one should I select? The answer to this conflict is that where there is a conflict between MPV and internal rate of return, you would have to select the project that is recommended by MPV. Why? Because our objective is to maximize the shareholders' wealth. So if our objective is to maximize the shareholders' wealth, the value of the MPV is what leads to the maximization of that shareholders' wealth. So if I undertake project A, I will increase my shareholders' wealth by 610. If I undertake project B, I will increase my shareholders' wealth by 1026. So 1026 and 610, which one do you want? So the simple common sense you have to pick out of whatever I've said here is, when the examiner creates the scenario and there are more than one product or project, and then there is a conflict between internal rate of return and MPV, or MPV and any other method of valuation or any method of evaluating or appraising the investment, you have to select the project that should be actually suggested by the MPV. So MPV is the overall boss because our objective is to maximize the shareholders' wealth. So in this case, because MPV says we should select project B, we will tell the examiner project B is supposed to be what? Selected. The question somebody will say is, why MPV and internal rate of return will give conflicting answers where there are mutually exclusive projects? The answer is just two. The first reason is that MPV is an absolute measure and internal rate of return is a relative measure. Because MPV, you get the absolute, the amount you will get from the project is a 610 or the 1026. Internal rate of return, being a return, is relative to the investment amount that you are making. So if I put 610 and I put 1026 on the table and I tell you to pick one, absolutely you will pick the 1026 because your value will increase by that 1026. The second reason is the reinvestment assumption. Okay, let me explain this. The reinvestment assumption, this is the principle. When you are undertaking a project, year 0, I put in investment of, let's say, 100. Year 1, I make 90. Year 2, I make 80. Year 3, I make 40, whatever it is. Okay, these cash flows, when we invest the 100 and year 1, okay, and year 1 you come and get year 1 you come and get your cash flows, what will you be doing? If year 1 I make a cash flow of 90, if I make a cash flow of 90, that 90 I cannot put it under my pillow. I am supposed to what? Reinvest it. You don't put it under your pillow. When your companies actually invest money and they get this 90 out, they don't put it under the pillow or they don't put it under the safe and lock it. They would have to what? Reinvest it. How long are we going to reinvest? And when we reinvest, what will be the return we are going to make? What will be the return we are going to make? This is where the conflict is. MPV is saying that when you invest it, the return you are going to make is equals to the cost of capital. Internal rate of return is saying that when you reinvest, you're going to make a return which is equals to the internal rate of return. And for the project to be undertaken, internal rate of return is greater than the cost of capital. And as such, that will be too optimistic. So this is where the difference is. MPV says when you get the cash flows, you will reinvest it at the cost of capital. Internal rate of return will say that when you reinvest it, you're going to get what? The internal rate of return. And that is where the conflict is coming. So if I do a project B like this and I reinvest the cash flow, if my cost of capital is 10% and internal rate of return is 18%, then it's telling me that, oh, internal rate of return is saying when you reinvest the money, you get 18%. Meanwhile, your cost of raising money is 10%. So there's a big gap, and internal rate of return will overestimate or overemphasize on a higher return, and being prudent will not be achieved. So therefore, all what you will need to be doing is that you have to select the project that is recommended by the NPV. And this is what actually brought what is called modified internal rate of return. So this criticism of the internal rate of return is what has brought what is called the modified internal rate of return. So modified internal rate of return is a new form of internal rate of return that is going to make assumption as the NPV made. So we are going to calculate an internal rate of return on the assumption that the cash flows from the project will be reinvested at the cost of capital, as the NPV actually said. So we want a new internal rate of return that will resolve the conflict between internal rate of return and the NPV, so that when we calculate NPV and the modified internal rate of return of the two projects, whatever NPV will suggest that the project we have to undertake, the modified internal rate of return will also suggest the same thing. So modified internal rate of return is the internal rate of return, which is the rate that will make the NPV equals 0 on the assumption that the cash flows will be reinvested at the cost of capital, and it will remove all the problems of internal rate of return. As you learned from your F9, you could have remembered that we said internal rate of return, there could be multiple internal rate of return. There's no issue of multiple internal rate of return so far as we deal with modified internal rate of return. This issue of reinvestment assumption being too optimistic is also cancelled. And then the issue of giving a wrong signal to select a wrong project where there are mutually exclusive projects is also cancelled out. So let's go straight to a figure or calculations to illustrate how to calculate modified internal rate of return. Okay, when you go to the room and you are given a question and you're supposed to calculate modified internal rate of return, I think it should be a straightforward question. So let's take this one to illustrate. Qatar PLC is considering an investment in a project which requires an immediate payment of $115,000 followed by a further investment of $5,400 at the end of the first year. The subsequent return phase net cash inflows are expected to arise at the end of the following years, year 1 up to year 5. Calculate the modified internal rate of return of this project, assuming a reinvestment rate equal to the company's cost of capital of 8%. Okay, this is the common sense. In the room, nobody is going to give you this net cash flows unless you are lucky. So when I have to calculate modified internal rate of return, I need an internal rate of return that the cash flows are reinvested at the cost of capital, so that my answer will be consistent with the NPV principle, because that principle is what is leading to maximization of the shareholders' wealth. Okay, so what we need to remember is, if the examiner creates the question, it's your responsibility to bring yourself to the net cash flows. As we did last week, we saw how to calculate net cash flows from sales variable cost, specific fixed cost, your tax savings on capital allowance, your initial investment, residual value, working capital, and you come and get the net cash flows. Before you ask yourself, what method am I using? Am I using NPV? Am I using discounted payback? Am I using internal rate of return? Am I using modified internal rate of return? But the good news here is that because we have taught you how to calculate net cash flows, we're not going back. So we have given you the cash flows and how do we calculate the modified internal rate of return. If you remember from last week, we made mention of the fact that in P4, you should be able to distinguish between the cash flows from the return phase and the cash flows from the investment phase. That is why I said MPV is calculated as the present value of the return phase cash flows minus the present value of the investment phase cash flows. Because when you are doing a project, you don't just start the project now and then you finish. If I have to construct this building, it's going to take some period before I'll be able to finish the construction, before money will start coming in. So my investment phase is how many number of years am I going to take to construct this. If you come to this question is telling us we will incur 15,000 now and we will incur 5,400 in a year's time. So my investment phase is year 0 and year 1. What is the PV of my investment phase? The PV of my investment phase is like what we normally refer to as the initial investment. So first, get the present value of your investment phase. So let's quickly go and do that. So I'll say PV of the investment phase cash flows. I say my years. This is 0 and 1. What are the cash flows? Question said 15,000 will be spent now, and then the 5,400 will be spent in a year's time. What discount factor? The cost of capital of the company is 8%. 8% year 0 is 1. 8% 1 year's time is 0.926. What is the PV? This is 15,000, and then this times that is giving us 5,000, and as such my total cash flows in terms of investment is going to be 20,000 minus. So in terms of today, it's like I have invested 20,000. Now, when I invest 20,000 in terms of today, I am going to make the following cash flows. According to modified internal rate of return, these cash flows are supposed to be reinvested at the cost of capital. So how do you get the return from it? So now let's go and get the return from the return phase. So we say return phase cash flows. Okay, how many years am I supposed to make those cash flows? 1, 2, 3, 4. According to the question, 5 years. What will be the cash flows? Let's copy the cash flows. 6,005, 7,715, 5,715, 4,750, and then 3,750. And then bear with me. We are saying we want an internal rate of return that is making an assumption that these cash flows from the return phase are reinvested at the cost of capital. My cost of capital is giving us 8%. So when I make this 6,500 in year 1 and I reinvest it, I will get the 6,500 plus whatever interest I will be making on. So I will say the multiplier. Okay, the multiplier, remember, is going to be on the basis of what? Compounding. And the interest rate is 8%. So my multiplier is 1.08. Multiply or raise the power, the number of years I'm investing is compounding, because when you invest, you make a return, you invest again. So year 1, if I make 6,500 at the end of year 1, I have to invest it and I will make a return which is equal to the cost of capital, which is 8%. And how many years am I supposed to invest it? Okay, I got the 6,500 at the end of year 1. Therefore, if the project is 5 years, I will invest it year 2, year 3, year 4, year 5. So I will invest it over a period of what? 4 years. So I have to raise it to the power 4. 1.03, this one, 1.08, this one will raise the power 3, 1.08 raised the power 2, 1.08 raised the power 1, and 1.08 raised the power 0. Then what will be the amount you will get at the end of the year? So you need to multiply, or at the end of the project life. When you multiply, you are getting 8,843, 9763, 6707, 5130, 3750. When you sum them up, remember any number raised the power 0 is 1. That's why here you're getting that. When you sum everything up, the total is 34,193. What is the common sense? I invested 20,000. That 20,000 brought in these cash flows. And when the cash flows came, I didn't put under my pillow. I reinvested it and I make a return of the 8%. So come the end of the project life, the total cash I have got from the investment is equal to 34,193. What then will be the internal rate of return? That internal rate of return we will get on the assumption that the cash flows are reinvested at that cost of capital is what is called the modified internal rate of return. So how do we calculate internal rate of return modified? Okay, I will say years. Year 0, that is what I am putting my investment, which is 20,000 now. And then this 20,000, when I put it in at the end of year 5, my total cash I have got is 34,193. Then I have to get a discount factor to get a PV. And that discount factor that will make the MPV to be equal to 0 is what is called internal rate of return. So the modified of it is that those cash flows are reinvested at the cost of capital to get this figure. So we need to calculate what discount factor here will bring the MPV to be equal to 0. Whatever discount factor you put here is going to give you 1 here. 1 times 20,000 will give you 20,000 minus, for the MPV to be equal to 0, this one is also going to be what? 20,000 positive. So a discount factor I will put here for year 5. When I multiply by this cash flow, it should give me the 20,000. What then will be that discount factor? I will say 20,000 divided by 34,193, and that will give me 0.585. So I have to go to my discount factor table or present value table. I am going to look for a percentage on the present value table. Go to your present value table. If you go there, you will look at a percentage on the 5-year line. That will give you a figure which is close to 0.585. So when you go there, it is between 11% and 12% on the line of 5 years. You are not going to use this in the exam room anywhere. But if you want to use it, the moment you get this figure, go to the table, present value table. You are looking for a percentage that when you drag it on the 5-year line, you are going to get what? A figure which is close to that. And when you drag, it is between 11% and 12%. So you will say the discount factor you have to put here, that will make the MPV equals 0 on the assumption that the cash flows were invested at the cost of capital is what is called your modified internal rate of return. So modified internal rate of return is between 11% and what? 12%. I'm teaching, that is why I have to let you understand this. But in the exam room, you are not teaching, you have to calculate it. So you are going to use a different way. This is just waste of time, okay? For the principle to be understood, that's why I'm doing it. In the exam room, the common sense is you have invested 20,000 and that 20,000 has grown to give you cash flow of 34,193. What is your growth? Your growth is your return. So you can calculate it the same way as we calculate the growth rate. And from F9, if you remember, we said growth rate is calculated as D0 dn 1 over n minus 1. And that is how you will calculate your modified internal rate of return. The argument is you invested 20,000 and that 20,000 has grown to give you a figure of 34,193 over a period of what? 5 years. So my modified internal rate of return should be given as I made 34,193 divided by the 20,000 raised the power 1 over 5 years minus 1. And this one will bring you to 11.3%. So to be honest with you, all this nonsense, please don't go and do that. I am teaching. That's why I wanted you to understand. And I did that. In the room, the moment you get your PV of the investment phase, get the cash flows, multiply by the 1 point, that particular cost of capital raised the power n years, and then get the overall amount. When you get the overall amount, you're going to tell yourself, I put in 20,000, that 20,000 has grown to give me 34,193. That growth rate is my return I have made. So your modified internal rate of return will be calculated as the growth rate, and everybody knows how to calculate what? Growth rate. And this is how you will calculate the modified internal rate of return. So that is one way you will use. If you go to the note, we illustrated this point here. I don't want you to bother yourself to think about this at all. Just use the growth rate principle, and then you go away. You come back to the 11.3%. Don't go and read by dragging on the 5th year line, trying to go and get the figure or percentage that will be close to 0.585. That is too long. Okay, so this is one alternative I will let you do. This one, don't even bother yourself to go and do. It's just waste of time. There is another way we can calculate modified internal rate of return. Okay, that is based on formula. And this formula is waiting for you in the exam room. The formula says the modified internal rate of return is equals to the present value of your return phase cash flows divided by the present value of your investment phase cash flows, all raised the power 1 over n, all multiplied by 1 plus r, all minus 1. It is a very big formula, but the good news is that the formula is waiting for you in the exam room, so you do not have to panic so much about it. The most important thing is you know the variables. This is the present value of the cash flows during the return phase. This is the present value of the investment phase. When will I recommend you to use this formula? If the question had asked you to calculate MPV, MPV is the present value of the return phase cash flows minus the present value of the investment phase cash flows. So if I have calculated MPV, then it means I've already got these two values. Slot them in the formula and your modified internal rate of return will come up. But if they haven't asked me to calculate MPV, I can decide to use this approach, or I can decide to use what? The multiplier approach, and use the growth rate formula to calculate it. What is the present value of the investment phase? We have already done that. So we are filling the formula. We said present value of the investment phase is 20,000. What is the growth number of years? Number of years is 5. So 1 divided by 5 multiplied by 1 plus r. R is the cost of capital, which is 1.08, all minus 1. Now I need the present value of the return phase cash flows. What will be the present value of the return phase cash flows? Present value means you get those cash flows and you discount it using cost of capital. So let's go and get the PV of return phase cash flows. Okay, so we're going to say year 1, year 2, year 3, year 4, year 5. Okay, and these are the cash flows, which are 6,500, 7,715, 5,715, 4,750, and 3,750. What discount factor? 8%. You go to your table, you pick 8%. Okay, and that is going to be 0.926, 0.857, 0.794, 0.735, and then 0.681. What then is the PV? 6,500 times 0.926, this is 6019. 7,750 times 0.857, this is 6,642. 0.794 times 5,750, this is 4,566. 0.735 times 4,750, this is 3,491. 3,750 times 0.681, and that is 2,554. Sum it up and you will get the PV. So I will say 6,019 plus 6,642 plus 4,566 plus 3,491 plus 2,554, and that is 23,272. So that 23,272 is the present value of the cash flows in the return phase. I come and put it here. 23,272. Solve this mathematically, and that will give you the modified internal rate of return. Divide by 20,000, raise the power 1, divide by 5, times 1.08 minus 1, and that will also give you 11.3%. So that will be your choice. Either you do the multiply approach and you put the calculation into the growth formula to get like your 11.3, or you use this formula approach. What is the decision rule and modified internal rate of return? If the modified internal rate of return is greater than the cost of capital, you will say you would have to what? Accept it. And if the modified internal rate of return is less than cost of capital, you will say you would have to what? Reject it. It follows the same principle as internal rate of return. Okay, what is the examiner doing in P4 exams and modified internal rate of return? The last time he tested was the December 2014. He also tested it in June 2012. So watch out. What he is doing is he will give you two projects, A and B, and he will normally calculate internal rate of return of A, internal rate of return of, let's say, internal rate of return of A, and then modified internal rate of return of A. And then he will tell you that calculate the modified internal rate of return and internal rate of return of B, and then select which of the project A and B should be undertaken. So that is the argument. So assuming I have got internal rate of return of A of 10%, here is, let's say, 12%, modified internal rate of return of 9%, and here is, let's say, 8%. Which project will I undertake? If I have to judge on the basis of internal rate of return, I will say I would have to do B. If I have to judge on the basis of modified internal rate of return, I will say I have to do A. Which one should I take? The one I have to take should be the one that will lead to maximization of shareholders' wealth. Internal rate of return, where there are mutually exclusive projects like A and B, it gives you a wrong answer. So which one should you take? You wanted to take the one that will be suggested by MPV. And the NPV assumption is what modified internal rate of return is using. Therefore, if you had calculated NPV would have told you to select the same project the modified internal rate of return will select. So the examiner is hiding. He knows that every student knows, oh, NPV is the best. So when he does NPV and internal rate of return, everybody will select the NPV one. So he is hiding it in behind modified internal rate of return. So remember, anytime modified internal rate of return conflicts with internal rate of return, select the project that is suggested by the modified internal rate of return, because that is consistent with the NPV, and as such that project will lead to the maximization of shareholders' wealth. So let's say bye-bye to the modified internal rate of return. I'm not sure if it should appear in your December exam. The statistics is what I've given to you. He tested it June 2012, and the last time was December 2014. Okay, now let's go to free cash flow. Free cash flow or surplus projected cash flows. Okay, what is free cash flow? From a layman point of view, free cash flow is called net cash flows, which we all have met net cash flows before. Net cash flow technically is called what? Free cash flow. Okay, what do we mean by free cash flow? Free cash flows are those cash flows which are available to be distributed to providers of capital. And providers of capital are debt holders and equity holders. Let me bring you in line with what you have learned before, because everybody knows free cash flow. When we were calculating NPV, how did we get the net cash flow? That net cash flow is what we are referring to as the free cash flow, because when you operate, you would have to sell your goods. When you sell the goods, you have to pay your variable cost. You have to pay your fixed cost. That sum of the cost will be called your operating cost. So when I make my sales pay for my operating expenses, money left, I use some to pay my tax, which is the tax and tax savings on the capital allowance. I use some to buy fixed asset. I use some to pay for working capital. Whatever money that is left, what am I going to use it for? Because the monies I got from operations, I've used it to pay my operating expenses. I've used it to pay tax. I have kept some for working capital. I've also kept some to buy asset. The money that is left, what am I supposed to use for? It is free. I don't need it for operations. I don't need it for asset. I don't need it to pay tax. That money is free. And that money which is free, I have to give it to the providers of capital, who are the equity holders and debt holders. So free cash flow is defined as the cash flow available to be distributed to providers of what? Capital. We use free cash flow to do so many things. The first one is we can use free cash flow to calculate the value of a company, and as such the price of a company. And this is the main thing we would have to do when we are doing mergers and acquisition. If company A is going to buy company B, how much should A pay to take over company B? We have to pay the share price. What share price? How to get that share price is what we are going to use one method called the free cash flow method, which we will see very soon. The second one is we can use free cash flow as a way of assessing company's performance. We will see it very soon. We can also use free cash flow as a way of evaluating a project using NPV technique. This one, I am not going to say anything about it. Everybody knows that. Because to calculate NPV, I have to get net cash flow. That net cash flow is what we are referring to as what? The free cash flow. So if you go to the exam room and the examiner says, calculate NPV using the free cash flow method, it's like he telling you, calculate the NPV using the net cash flow method. Nothing has changed. It's going to follow your normal NPV calculation. So So remember, your free cash flow is your net worth cash flows, which is your sales, variable cost, specific fixed cost, tax savings on capital allowance, initial investment, residual value, and then your working capital. That money is free and it should be distributed to providers of capital. And who are the providers of capital? Debt holders and equity holders. Now let's come to the next level. Okay. When you are supposed to calculate a free cash flow or net cash flow, and they give you sales, variable cost, fixed cost, tax, and all that as we normally do, we assume that those figures are cash figures. So that one is straightforward. That is what we know from F9 up to this level. Okay, what about if the examiner wants me to calculate the net cash flow, but the examiner has given me income statement and a balance sheet? In simple terms, the examiner had given me accounting information. If the income statement is given to me and a balance sheet or statement of financial position is also given to me, my question is, the profit in the income statement is not cash, because income statement is supposed to be prepared on the basis of the accrual concept, and some non-cash items like depreciations are also included. So when accounting information is given to me, it is my responsibility to convert the accounting information like accounting profit into cash. And all of you, you've done F7 and you prepared cash flow statement. And when giving accounting information, how did you get the cash? You said cash flows from operating activities, cash flows from investing activities, and the rest is cash flows from financing activities. So my free cash flow will be the manipulation of the cash flows from operating activities and cash flows from the the investment activities. So the cash flow from operating and cash flows from the investing, whatever is left is what is going to cash flows and financing activities. And cash flows and the financing activities, we made mention of money to equity holders, money from equity holders, money to debt holders, and money to what? Money from debt holders. Okay, the examiner and P4 is not going to test you on the whole cash flow statement. As long as P4, or so far as P4 is concerned, this is a template you are going to follow. So when I want my free cash flow from accounting information, my first requirement is I have to get my profit before interest and tax. When I get the profit before interest and tax, I would have to less my tax. Point of attention, we all know that interest is a tax allowable expense, no argument about that. But whom do we give interest to? We give interest to debt holders. And we said the free cash flow you are looking for is monies to be given to debt holders and monies to be given to equity holders. Therefore, the interest that is supposed to be given to the debt holders is part of this free cash flow. So when you are calculating the free cash flow, totally ignore interest, because that interest should be part of the figure that you are looking for. So don't deduct interest up here. That is why if you look at the template, they've said profit before interest and tax less your tax. Your tax is not the tax in the income statement. Your tax should be calculated as your profit before interest and tax multiplied by the tax rate. Okay, so watch out. Examiner will tempt you by bringing in the interest. You ignore the interest. So that tax will be the profit before interest and tax multiplied by the tax rate. Then, if I deduct the tax from it, I have to ask myself, this profit before interest and tax I picked, it involves accounting things, which will involve non-cash items like depreciation, amortization, and all that. But so far as P4 is concerned, is depreciation / what? Capital allowance. So if there is depreciation or capital allowance, add that non-cash item like depreciation or what? Capital allowance. And you ask yourself, is there any money I need to buy fixed asset? And that is what is called capital expenditure. So I made this profit by saying pay the tax, and I added non-cash items. The moment I added the non-cash items, I have brought the profit into cash. That cash left, I have to use some to pay for purchasing of asset. I have to use some for working capital. When you were doing your cash flows from operating activities, you said increase in inventory, deduct. Decrease in inventory, add. That is the working capital movement. So if working capital increase, money is gone out, you have to reduce it from your cash. If working capital decrease, you have received the money, and as such, you have to what? Add. So that's what I have done here. Less increase in working capital and add decrease in working capital. And that will give you the free cash flow. It's a template. So I normally ask my student to have this template on your eye. The moment you see you need free cash flow, go ahead and calculate it accordingly. So let's take this example to illustrate. HWT PLC has earnings before interest and tax of 225,000 for the current year. Depreciation charges for the year have been 15,000 and working capital has increased by 2,500. The company needs to invest 22,500 to acquire non-current asset. Profit are subject to taxation at 30%. Calculate free cash flow. It's a template. So ask yourself, where is my profit or earnings before interest and tax? Question told me is 225. Bring that 225. When I get the profit before interest and tax, I have to apply my tax straightforward on that figure. What is the tax rate? Tax rate is 30%. 30% of the 225,000 is what is giving me that. I have to less the tax. Then I need to add back non-cash items. It's a template. What is the non-cash item? The non-cash item is the depreciation here. How much is the depreciation? Question says it's 15,000. I add it. I ask, do I need money for buying fixed asset? They said we need to buy fixed asset of 22,500, or fixed asset is the same as non-current asset. That is the 22,500. Do I also need money for working capital? They said 2,005. I also did that. This money that is left, what am I supposed to use for? It is not meant for working capital. It's not meant for asset purchase. It's not meant for paying operating expenses. It's not meant for paying tax. So that money is free, and I have to give it to my shareholders and debt holders. That is the free cash flow. Okay. Next, what is free cash flows to equity? Okay. Dividend capacity. Okay. Now be with me. We have moved a step further. First, we said free cash flow. Free cash flow is cash flows to be given to debt holders and equity holders. Is the money available to be distributed to providers of what? Capital, full stop. Okay, and providers of capital are the debt holders and equity holders. Okay, now, if I come and say free cash flows to equity, what is the meaning of free cash flows to equity? Now, I'm being specific to only equity holders. So I'm telling you, the free cash flows to equity will be the cash flows which should be available to be paid or distributed to only equity holders. So watch out. Is the examiner looking for free cash flow, or is he looking for free cash flows to equity? If it is free cash flow, we want for both debt and equity holders. If it is free cash flows to equity, we want the money available to be given to only equity holders. And how will we calculate it? It is also a template. I will pick my profit before interest and tax. But now, because I need free cash flow to equity, it should be given to only equity holders. And as such, there's no debt holders. So interest is supposed to be paid out before whatever is left is supposed to be given to equity holders. That is why we are deducting interest. Deduct your tax. So basically, my profit before interest and tax, less interest, less tax, is what is giving you profit after tax. And when you go to the income statement, which of the profit is supposed to be given to equity holders is what we refer to as profit after tax. So when I pick the profit after tax, it's not cash, it's profit. So what am I supposed to do? I am supposed to convert the profit into cash. Therefore, were there any non-cash items like depreciation? If it is there, then I need to add the non-cash items of what? Like depreciation. Then I ask, if I add it to it and I've brought it to cash, then this cash, I need some to pay for non-current asset, which is the capital expenditure. I also need some to pay for my working capital, and that is the working capital movement. And then we have to also consider two additional things. Is there any proceeds from the issue of debt? If there's proceed from issue of debt, money has gone up, so I would have to add proceed from issue of debt. Are we also supposed to repay debt? If you have to repay debt, what is left? It means that money that you are going to pay should get out of the monies available. So when you finish that, every money left is attributable to equity holders. So the only thing I tell students is this: the difference between free cash flow and free cash flow to equity will come from three areas. Okay, the interest here, and then proceed from issue of debt, and then what? Debt repayment. These are the three things that differentiate free cash flows and free cash flows to what? Equity. So watch out. Hold on for the dividend capacity. I will bring you back. So let's go and take this example quickly in order to do the free cash flow and free cash flows to equity. The following data relates to MLS Limited. Forecast income statement for next year. Revenue, cost of sales, gross profit, operating expenses, earnings before interest and tax, interest charges, profit before tax, corporation tax, profit after tax. During the year, loan repayment are expected to amount to 69 million, depreciation charges to 30 million, and capital expenditure to 60 million. The dividend payable is 30 million. Okay, required. Calculate the free cash flow, free cash flows to equity, dividend cover based on free cash flows to equity. Okay, hold on, and the dividend cover. I want you to get the free cash flow to equity first, and I'll bring you to the next level. So how do I calculate my free cash flow? It's a template. I pick my profit before interest and tax. I less my tax. I add non-cash items like depreciation / capital allowance. I deduct my capital expenditure. I deduct my working capital increase or add working capital decrease. And that is my free cash flow. So if this is the principle, I come to the question, where are these? Okay, so you will say, you need your free cash flow. So I will say my free cash flow will be my profit before interest and tax. When you pick the profit before interest and tax, it's giving us, is it 313.50? Then I will say less what? Tax. Tax rate is 35% of the 313.50, and that is 109.72 minus. I add my non-cash items, which is depreciation. Question told me my depreciation is 30. I am not going to take time to underline this, bring after that, and then I'll bring the depreciation. Go ahead. Nobody cares about that. What we care is the free cash flows that you're getting. So when I finish, I add, is there any capital expenditure? Less than your capital expenditure. They said we have to buy asset of what? 60. I ask, is there any changes in working capital? Question says no. So this one should give me the free cash flow of 173.78. Full stop. Okay. Next. Question wants us to calculate free cash flows to equity. There are two ways you can calculate the free cash flows to equity. Okay, and we're going to illustrate all of them. Okay, if you go to the exam room and the examiner wants you to calculate free cash flows to equity, there are two ways he can trick you. The first way is that he will give the income statement and other information, and you have to start from fresh to calculate the free cash flows to equity. Alternatively, he can give you free cash flows, and when the free cash flows is given, he will give you other information for you to make adjustment to make the free cash flow, adjust it, and come and get the free cash flow to equity. Okay, so we're going to illustrate all of that. If I am calculating it from the scratch, then I will need my template for the free cash flow to equity. And if you remember, your profit, the profit that is supposed to be given to equity holders is the profit after tax. It's the profit after tax. Okay, so when I come here, I am not going to say my profit before interest and tax, less interest, less tax, and I come and get my profit after tax. I will pick my profit after tax straightforward. So my profit after tax is going to be, so profit after tax is giving us, 1 minute, is 188.18. When I get profit after tax, I would have to add back my non-cash items like depreciation. Depreciation is 30.00. We add in. Okay, so you add back and you ask, is there any changes in working capital? No. Is there any fixed capital? Yes. So my capital expenditure will be given as what? 60. And I ask the question, is there any debt to be repaid, or is there any proceed from the sale of what? Debt or issue of debt? According to this question, we have to pay a debt. So debt repayment or loan repayment is given as 69.00, and this one will give me free cash flows to equity, and that is simply 89.18. This is one way you can do it. This is from the scratch. What about if I have been given the free cash flows to equity? If I have been given the free cash flows and I want free cash flows to equity, so giving me free cash flow, I can convert that free cash flow to free cash flows to equity. There are only three things I would have to be looking for. As we indicated earlier, the only three things that separate free cash flow and free cash flows to equity are the interest, the amount of proceed from the sale of or issue of debt, and repayment of debt. These are the only three things. So giving me free cash flow, if I want my free cash flow to equity, I come to the question, where is your interest? Where is the loan repayment? Where is the proceed from the sale of what? Or from the issue of debt? That is what I'm asking. Make adjustment to the free cash flow, and your free cash flows to equity will come out. Okay, so now let's go straight. I will say my free cash flow is giving us 173.78. Then I ask, is there any debt repayment? There is debt repayment, loan repayment. Loan repayment, they said, is 69.00. Is there any proceed from issue of debt? Question didn't say anything, so I assume it doesn't exist. Then I ask, is there any interest? This is where you would have to be with me. The interest, you are not supposed to come and put the whole amount of interest there. You are not supposed to come and put the whole amount of the interest there. Somebody will say, why? Because interest is a tax allowable expense. So when I pay the interest, it should save me tax. So my cash flow should increase by the tax that I am saving on that particular interest. So remember, what you need here technically is net interest. And the net interest is the interest amount. When you go to the question, the interest given is 24. So that 24 multiplied by tax rate of the tax rate is 35%. So multiply by 1 minus the 0.35. If tax rate is 35%, the net is simply what? 65%. So you multiply 65% of the 24 times 0.65, and that is giving me 15.6 minus, and this will give me the free cash flow to equity of 89.6. So whichever the examiner will do, I believe you should be very comfortable. I believe you should be very comfortable. So either he gives you the free cash flow, give further information in relation to interest, loan repayment, proceed from issue of debt, and you'll be asked to calculate what? Free cash flow to equity. Or he gives you everything and you have to calculate the free cash flow to equity. Now let's go to the dividend capacity. Okay, let's go to your dividend capacity. What do we mean by dividend capacity? What do we mean by dividend capacity? Okay, what do we mean by dividend capacity? Right. Dividend capacity is a measure of assessing the ability of the company to pay dividend. Dividend capacity is assessing the ability of the company to pay dividend. And at your F9 level, the ability of the company to pay dividend, we calculated it using what is called dividend cover. And that dividend cover is assessing the number of times the company can pay dividend. And how do we calculate it? We said the dividend cover is your profit after tax divided by your dividend. Okay, so if my profit, for instance, after tax is 20 and my dividend is 10, it means I have got the ability to pay dividend twice. The biggest question here is, have you truly got the ability to pay dividend twice? The answer is no, because you said your profit is 20 and I have to go and pay dividend of 10. When you are paying dividend, even though dividend is paid out of profit, the medium of payment is cash. So the fact that I have made the profit of 20 doesn't mean I have got the cash there. So this measure of the ability to pay dividend is deceptive. Assuming all my sales were on credit and I haven't got any cash and I have made profit of 20 and I go and tell shareholders we have the capacity to pay dividend what? 2 times, and shareholders say okay, pay the dividend. Where are you going to get the money to pay? So the profit used as a basis of assessing the ability of the company to pay dividend is not going to be a good yardstick. What will be a good yardstick for assessing the ability of the company to pay dividend is what cash is available for us to use to pay the dividend. And the cash available to be given to ordinary shareholders or equity holders is what we refer to as the free cash flows to equity. So from now onwards, when you go to the exam room and the examiner creates a question and he wants you to calculate or assess the dividend capacity of the company, you are going to assess it as the free cash flows to equity divided by the dividend. Okay, so when they want you to assess the dividend capacity, your free cash flow to equity is 8918. How much is the dividend? Question told us our dividend is 30 and we can pay the dividend what? 2.97 times. So if customers or our shareholder says we should pay the dividend, we have the money to pay. So when we tell we can pay you 2.97 times. If we're using our F9, I normally say the primary school staff, we would have said, okay, is the capital expenditure the forecast capital expenditure or the forecast expenditure? I've done yes, the capital expenditure should be the forecast. Okay, it depends on what or the period you are calculating the free cash flow. If I'm calculating free cash flow for the future, then it should be the future one. If I'm calculating the free cash flow for now, then it should be the capital expenditure that I have incurred now. So at what point do you need that free cash flow? The point you need the free cash flow, that is where you would have to bring it toward capital expenditure. Okay, so that is the case. Brilliant. So if you want to assess the dividend capacity, please make sure you are assessing it on the basis of the free cash flows to equity, because that is the money available. Now let's go to what your P4 exam is more likely to test you on. Valuing a firm using free cash flow method. This is the most common way of valuing a company. Okay, most of the valuation you need for mergers and acquisition is being tested on free cash flow. So be with me. Okay, now let's go straight and make analysis. According to the valuation using free cash flow method, okay, your value of your company, which they normally call it your corporate value. Your corporate value is going to be calculated as the present value of the future free cash flows. So going back to that question that somebody asked, okay, is it Walter? Walter, getting back to your question. So far as I need the corporate value, I need the present value of the future free cash flows. Therefore, okay, therefore, my capital expenditure I have to use should be the future capital expenditure, not the one that I have incurred. So it's going to be the PV of the future free cash flow. Once I need PV, it means I need the free cash flow discounted. What discount factor should I use? The discount factor I should use should be the appropriate, if you remember that word. And once it's appropriate, it means it should be consistent with the cash flows. Free cash flows, we said they are cash flows to be given to both debt holders and equity holders. So if it is cash flows for both debt holders and equity holders, then I will also need a cost of capital that is also for debt and equity holders. And that cost of capital for debt and equity holders is what is called the WACC. So when I have to get the present value of the free cash flow, I need to discount it using WACC so that I will compare like against like. Cash flows are for both debt and equity. WACC or cost of capital is also for both debt and equity. So when I find the present value of the free cash flows using the WACC, it gives me what is called corporate value. And your corporate value is value for both debt holders. So it's debt value plus your equity value, because that cash flow is for those two groups, isn't it? Equity debt, equity holders and debt holders. So when you get the corporate value, is the value of debt plus value of equity is what is called the corporate value. So if A is going to buy B, we have to pay for the shares or equity of what? B. And the examiner will want you to calculate the equity value of B. How will you do that? When I find the present values of the cash flows of B, it will give me the corporate value of B. What am I looking for? I'm looking for value of equity. Giving me the corporate value, I need to take off the debt value, and that will give me my equity value. So your equity value can simply be calculated as your corporate value minus your debt value, and that will give you your equity value. Please be with me. This is the challenge in the exam room. This is the challenge. Examiner is not going to give you the figures like that. The question is created and you are supposed to wind out in order to come and get the equity value. So picture this. So when I want the equity value of a company and I'm asked to use the free cash flow method, I would have to generate my free cash flow first. How will I get my free cash flows? I need to get my operating profit, less tax, add non-cash items, working capital, capital expenditure. I come and get the free cash flows. Okay, if I've got the free cash flow, I have to discount using WACC. Question, where is the WACC? The WACC is not given. If the WACC is not given, the examiner will expect me to calculate WACC because calculation of WACC is part of your syllabus. So if the WACC is not given, you go and calculate what? Your WACC, which we will see it later. So when you calculate your WACC, you come and get the WACC, you discount the free cash flows with the WACC. It gives me what is called corporate value. I'm looking for equity value, and I know that corporate value is equal to debt value plus equity value. Therefore, my equity value should be corporate value minus debt value. I go to the question, where is the debt value? If the debt value is given to me, I take it off the corporate value to get my equity value. If the debt value is not given to me, then the examiner is expecting me to calculate the debt value. Okay, so this is how it is. That's why I keep telling you, P4, the topics are related. So I can't say, oh, I like valuation, but I don't like cost of capital. You need to calculate the cost of capital before you be able to get the value. Okay, so what I will say here to your question is when we use cost of capital and when WACC in calculating NPV. Yes, if I'm using my WACC, the cost of capital of the company, there are so many things in here because the moment the business risk and financial risk is going to change, my WACC is also going to change. So I will say you would have to hold on there for me until we get to cost of capital. Okay, that is the reason why I'm looking for the word appropriate discount factor. Appropriate here means this should be consistent and the WACC should reflect your risk. So if my risk will change, my current WACC will not be appropriate. I have to calculate the project word specific WACC. So at this point, I will say you hold it on for me until we get to cost of capital. And when we get to cost of capital and the measures and acquisition, we will come back to this. The reason why we put this one here for you is to play with them so that by the time that we get to measures and acquisition, you know this free cash flow. And when we have to bring you up to the specifics where we would have to bring the business risk and financial risk in calculating the WACC, you will appreciate it the better. Okay, so the whole idea is get your free cash flow, discount them using the WACC. If the WACC is not given, you have to calculate it and then get your corporate value. Take the value of debt. If the value of debt is not given, you have to calculate the value of debt before the value of equity will come out. And you tell the examiner that, oh yes, A buying B. B, we are going to pay you this value. Okay, so this is how it flows. The alternative is we calculating the value of equity using the free cash flow to equity. And according to the free cash flow to equity, your equity value is going to be the present value of the free cash flows to equity. If it is free cash flow to equity, what discount factor am I supposed to use? Appropriate, always appropriate. Remember, the discount factor should be consistent with the cash flows. Straightforward. The cash flows I'm doing or using here is the free cash flows to equity. It's got nothing to do with debt. So I can't include a cost of capital that includes debt. So straightforward. I have to discount using what? Cost of equity, full stop. The cost of capital is a problem. That is why in the note we indicated appropriate. You don't use them anyhow. You have to compare like against like. So let's go to our notes quickly. We go and pick this to illustrate. Okay, so this question is going to be your base, and I'll be referring you to this. If you look at chapter number 2, it's packed. There are so many things in there. That's why we haven't moved. And don't panic at all, because when we go to the other chapters, you see we are rolling over quickly. I'm very happy for you to understand this chapter number 2 well, because when you get it well, the other coming, apart from the hedging, is going to be relatively easy for everybody. Okay, so now let's start. Example, Telto Limited. The finance team of Telto Limited has produced the following forecast of financial data. Financial year: net sales, cost of goods sold, sale and distribution expenses, capital allowances, interest, cash flow needed for asset replacement. Corporation tax is at the rate of 30% per year, payable in the year that the taxable cash flow occurs. Assume that the company's weighted average cost of capital is 14%. The market value of debt is 30 million. Required: calculate the value of the company if, okay, be with me. You are going to get only one of this. We have selected all the various ways the examiner is doing the present values. Present values, annuities, perpetuities, and all that. And we've used it to do this, so that when you get this, at least one of them is what is waiting for you in the room, so that you'll be able to do all of them. So A, we are assuming the cash flows are expected to remain at S4 level into infinity. B, cash flows are expected to remain at S4 level up to the end of 14 years horizon. C, cash flows are expected to grow at the rate of 3% per year after S4 with overall horizon of 14 years. C, cash flows are expected to grow at the rate of 3% per year after S4 into infinity, and cash flows are expected to grow at a rate of 5% per year after S4 to X6 inclusive, and then at 4% indefinitely. Okay, one of them is what you are going to face there. So we're going to take them one. Typically of your free cash flow questions, examiner will open up to some number of years and then he will project it into the future. So they've given us accounting information forecast for the next 4 years. If I want the corporate value, my company value is the present value of the future free cash flows. Therefore, how will I get the free cash flows? I need my operating profit or profit before interest and tax. I need my tax. I need my add back my capital allowance or depreciation, less working capital, less fixed capital. I get the free cash flow. When I get the free cash flow, I have to discount it using WACC. So this is my principle. This will run here, and the moment it runs, I come to the question and I come and ask for specifics. Okay, I have been given sales, cost of sales, selling and distribution expense, capital allowance. I need my profit. If I need my profit, am I going to say sales minus what? Those costs. So let's open and we start doing the calculations. So I will say yes. Yeah, X1, X2, X3, and then what? X4. Okay, I will say my sales figures here are given as 230, 261, 281, 298, and I will say my cost of sales is 115, 131, 141, 149. Okay, and I am going to say my selling and distribution expenses 32, 34, 36, 38. I pick them. Then I will say my capital allowance is representing like my depreciation. Is it 40, 42, 42, and then 42? These are the capital allowances representing like my depreciation. When I sum up all of that, I get my profit before interest and tax, which is 43, 54, 62, and then 69. When I get the profit before interest and tax, what do I need next? I need my tax. So I will say tax. What is the tax rate? Question says tax rate is 30%. 30% of what? 30% of the profit before interest and tax. Do you see interest in the question? There is interest in the question. Do I care? I don't care because it's part of the free cash flows I'm going to calculate. So leave it out. Examiner will intentionally tempt you. Leave it out. Okay, so I'm going to multiply 30% of the 43 is approximately 13. 30% of the 54, 16. 30% of the 62 is 19. 30% of the 69 is what? 21. These are tax lesson. Then I have to add back my non-cash items. What are the non-cash items I've used up here? It's only the capital allowance, which is like the depreciation. I need to add back. So add back my capital allowance, which is 40, 42, 42, and 42. Then I ask, is there any changes in working capital? Question didn't say anything about working capital. I can't force myself. I ask, is there any cash flow associated with buying non-current asset? You need to ask yourself these questions, and the question in front of you will give you the answer because you are asking the questions through the principle. I need cash flow for purchasing of asset, and question told me cash flows needed for asset replacement. Are those figures in there? I pick them. So I will say capital expenditure for the future because now we're looking for the future cash flows, isn't it? So I will say it's 50 minus 52, 55, and then what? 58. And these are minus. When I sum them together, it's going to give me my free cash flow. Okay, and the free cash flows are 20 here, 28, 30, and then 32. So if these are the free cash flows, what discount factor do I need? I need the WACC because this is free cash flow. I go to the question, what is the WACC associated with this? So far as we haven't taught you WACC so far, this question is giving us a WACC of what? 14%. So we pick the 14%. If you go to the room and the examiner give it to you, pick it. If he doesn't give it to you, then unfortunately, he is calling upon you to go and calculate it. So 14%, year 1 is 0.877, 0.769, 0.675, 0.592. And then what will be the present values of them? This is 17.54, 21.532, 20.25, 18.944. So when I get these figures, I've got the present value from year X1 up to X4. So the PV X1 to X4, how much is that? You sum up all of that and that will bring you to 78.266. Okay, then you go and ask the question, I've got the present value year 1 to year 4. Am I going only up to year 4? You ask the question. When we go to the question said in A that we should assume we're going to infinity. So if we're going to infinity, how do you want me to do the cash flows? Cash flows question said it's expected to remain at S4 level up to infinity. And anytime the cash flow is going to infinity, we call it a perpetuity. And how do we get a perpetuity? The present value of a perpetuity, if you remember, let me refresh your mind on this. The present value of a perpetuity depends on whether the perpetuity is constant. Whether the perpetuity is constant or the perpetuity is growing. If it is constant or growing, they have got different formulas. So watch out. If the perpetuity is constant, the PV is equals to that constant cash flow divided by the cost of capital. Okay, multiplied by discount factor of the base year. If the perpetuity is growing, you're going to get the cash flow now into bracket 1 plus the growth rate divided by the cost of capital minus the growth rate multiplied by discount factor of the base year. Okay, this follows the same formulas as the dividend valuation. When you did your dividend valuation, we said the value of the company is the present value of the future dividend. If the dividend is growing, this is the formula you use. If dividend is constant, this is the formula you use. It is following perpetuity. So my advice is, anytime you pick a perpetuity question and then you see that it's a perpetuity, ask the question, is your perpetuity constant or is your perpetuity growing? When we come to this very question that we're doing, it's telling us A, perpetuity is constant cash flow because it's remaining at S4 level up to infinity. So if it's remaining at S4 level, S4, what was our cash flow? Our cash flow at S4 level, is it the free cash flow of this 32? They're telling me that this 32 is going to stay constant up to infinity. So I have got a perpetuity which is constant. So which formula do I need? This is the formula I need. So I will say PV year S5 up to year infinity. I will need that free cash flow constant divided by the WACC multiplied by discount factor of the base year. Okay, discount factor of the base year. Year 4, the cash flow is 32 divided by WACC of 14% multiplied by discount factor of the base year. The base year, I base the figure on 32 and that base year is X4. Therefore, what is the discount factor of what? X4. That is 0.592. Common sense is that when you wanted to get the present value of this 32, you multiply by this to get that, isn't it? Therefore, if you want to bring it to year 0, you still have to multiply by that. So we will multiply by here 0.592 and that will give you 135.31. When you sum them together, it should give you the value of the company, which is 213.58. So this is your corporate value. So if this is your corporate value, is the value of the company. If I needed value of equity, I have to take the value of debt. So I ask the question, is there any value of debt? Question says value of debt is 30 million. So if I want the value of equity, I will say that my value of equity will be the corporate value less value of debt. So equity value is simply the corporate value of 213.58 minus your debt value of what? 30, and my equity value is 1358. So this is one way the examiner will do the calculation of equity for you, and you will suggest that they have to go and pay 183 to take over the value of that particular company. Okay, next we are handling them 1-1. So when we come to B, the question is the PV X1 to X4, we have got it as 78.266. How far are we going? Let's go and read as requirement B. It's saying cash flows are expected to remain at S4 level up to the end of 14 years horizon. We are not going to infinity this time. We are going to 14 years. When cash flows are the same from one point to another point, 1 year to another year, we call it an annuity. When the cash flow is going to infinity, we call it a perpetuity. When the cash flows are the same from 1 year to another year, we call it an annuity. Therefore, this is an annuity situation. So I will say my cash flow, what will be the PV? X5 up to X what? 14. My cash flow is going to be the 32, which is constant. What will be my discount factor? Is it 14%? And this one will give me the PV. How do I get the discount factor? Okay. Annuity table is what I have to use. Annuity table takes what? The sum of the present value table. So when I pick 14%, 14 years, 14%, 14 years has sum from year 1 up to year 14, isn't it? It has sum from year 1 up to year 14. Okay. Then So what we're saying in scenario B is that we have got an annuity, and because we have got an annuity, then we have to pick the discount factor from the annuity table. And if we have to get it from the annuity table, if I pick 14%, 14 years, it has sum from year 1 up till year 14. But I'm not interested in year 1 up to 14. I'm interested from year 5 to what? Year 14. So when I pick 1 to 14, I have to deduct what? 1, okay, 1 to 4 out. Somebody is saying not for me. Okay, is it working now for the others? If it's not for you, then I think it should be your system. So try and reboot it. Okay, so what will be the annuity factor here? I'm showing the working. Okay, I'm showing the working. Brilliant. So we'll say pick annuity factor 14%, 14 years. And that is given 6.002, and less annuity factor 14%. Because it's 5 to 14, you need to take what? 4 years out, and that is 2.914. And that difference should be the annuity factor 5 to what? 14. 6.002 minus 2.914, and that is given 3.088. And then when you multiply by 32, it's given 98.816. When you sum them up, plus 78.266, it will give you 177.082. This is your corporate value. You need to less your debt value, and when you less the debt value here is 30.00, and that will give you your equity value. It follows the same principle. So minus 30 is 147. So it's the same question. We are trying to vary it in order to see what the examiner might probably do. Now I'm skipping the C and I'm going to D and E. I'll bring you back to C because the C is the highest level of all. So let's go to D. D, I will say PV 1 to what? X4. We got a total cash flow of 78.266 in terms of present value. Let's go and read D. If I read D, D is saying cash flows are expected to grow at the rate of 3% per year after S4 into infinity. So once I'm going to infinity, I've got a perpetuity. What perpetuity have I got? Is it a perpetuity constant or is it a perpetuity with growth? It's a perpetuity with growth. So if it's a perpetuity with growth, then what formula do I need? That is what I gave to you here. This is the perpetuity with growth. So I have to come and pick that. So I will say my PV X what? 5 to infinity will be the cash flow into bracket 1 plus the growth rate divided by the WACC minus the growth rate multiplied by discount factor of the base year. What is the free cash flow? We are picking from year 4. The year 4 cash flow is 32. Is growing at what? 3% divided by the WACC of 14% minus 0.03 multiplied by year 4 discount factor, which is 0.592. And what will be the answer? 32 times 1.03 divided by into bracket 1.4 minus 0.03 and then multiply by 0.592, and that is given is 177.38. Sum them up and that gives you your corporate value plus 78.266, and that is 255.65. Okay, approximate. Okay, so what are we going to have? And then less your debt value. Your debt is 30, therefore your equity will be what? 225.65. Straightforward. Okay, now let's see the D. The E. The E2 will say PV X1 to X4. We got is this 78.266, and that's 78.266. What then will be the PV up to the next? We have to go and read. Question is telling us in the E that cash flows are expected to grow at the rate of 5% per year after X4 to X6 inclusive, and then X at 4% indefinitely. So my S4 figure is supposed to be increased by 5% to year 5 and to year 6 before it will grow by 4% to infinity. So this is the breakdown. So we're going to say year X5, what will be my cash flow? I have to pick the 32 and grow it by 5%. So 32 times 1.05 is 33.6. This is the cash flow. Year X6, that 33.6 should also grow by 5%. So times 1.05, and that will give me 35.28. These are supposed to be discounted using what? Is it 14%? I go to the table. 14% discount factor 5 years is giving 0.519, 6 years 0.456. When I multiply, this one is giving me 17.44, 16.09. Then after year 6 is going to grow by 4% to infinity. So once it's going to infinity, this is where the perpetuity kicks in. And perpetuity is saying PV year X7 to infinity. I have to get the free cash flow. It's a perpetuity with growth. So divided by the WACC here minus the growth rate multiplied by discount factor of the base year. So I will say, what is the free cash flow? The free cash flow now, because it's year 7, our base is going to be year 6. Year 6 free cash flow is the 35.28 multiplied by the growth rate of 1.04 divided by the WACC of the 14% minus the growth rate of 0.04 multiplied by discount factor of the base year. What is the base year? Base year is year 6, and year 6 discount factor is this. And I'm going to multiply 35 by 2, 8.1.04 divided by bracket 1, 0.14 minus 0.04 multiplied by 0.456, and that is giving 167.31. So when you sum up all of that, what will you get? 1 minute. When you sum up all of that, what will you get? And that will give us our corporate value. And your corporate value is going to be 279.106. Take your debt value out of the 30, and then you will get your equity value, which is 249.106. Okay, so that is how it works. One of these alternatives is what the examiner is likely to bring. Now let's go and see the requirement C. Let's go and see the requirement C. Requirement C is saying cash flows are expected to grow at the rate of 3% per year after X4 with overall horizon of 14 years. Be with me here. This one is not growing by 3% to infinity. If you look at the D, it's growing by 3% to infinity. That is why we needed the infinity with the growth formula. If I am not going to infinity, those formulas, these formulas doesn't apply. It applies only when the cash flow is growing and is growing up till infinity. So watch the difference. So here, X is growing by 3% up to year 14. So one way somebody could have done, which is not recommended in the exam room, is this. You will open year X1 up to X4, and you will grow this 32 at S4 up till year 14. So you open up to 14 years, and time will not allow you to do it. Even your sheet, when you turn it like this, you are not likely to get a space to do year 1 to year 14. That will be technically difficult. Okay, so you have to apply mathematics here. And what is the common sense? Be with me. We all learned last week about real and nominal. Growth rate has got the same effect as inflation. So what we're going to do with the C here is that I have got PV X1 to what? Is it S4? And we said the figure is simply 78.266. Now I need the PV X5 up till X what? 14. And what is going to happen is this. So be with me. The period involved are X1 to X4 and then X5 up till X14. So this 32 I have got in X4, I would have to what? Increase it by whatever percent, 3% up till the year 14. So when I increase it, I will discount using the nominal value of 14%. So what can I do? Okay, what can I do? What I can do is, instead of me increasing it by 3% and multiplying by the 14%, I can decide, okay, not to inflate it. I can decide not to increase it. If I don't increase it, it's like I haven't inflated it. And if I've got a cash flow which is supposed to be inflated and I don't inflate it, I have kept it at real. So when I keep it at real, I will say here S5 to S14, my cash flow is going to stay constant at the 32, because that 32 is what I was supposed to inflate it and I haven't inflated. So I am keeping it at that 32. And if I'm keeping it at 32, that cash flow is not subject to inflation yet. And that cash flow will be called a real cash flow. So if it is a real cash flow, I cannot discount using nominal cash flow of 14%. It will be my job to convert the 14% from nominal to what? Real. And Fisher will call us 1 plus the money rate is equals to 1 plus the real rate, 1 plus the inflation rate. Money rate is 14% divided by the growth rate, which is represented by inflation, is 0.03 minus 1 is equals to the R. And what is your real rate? And when you calculate that real rate, you're going to get a figure which is simply 11% on average or approximate. So if it is 11%, then this 32 being real cash flow will be discounted at 11%. And once I've kept it at 32, I have got an annuity. Okay? Right, so if I have got an annuity, I will say year S5 to X14, I'm keeping the cash flow at real at 32. I have to discount it using 11%. And now be with me. This 11%, what period is the real? From here, X1 to X4 is nominal period. And from S5 to X14, that cash flow ought to have been inflated and you didn't. So you say this period is the real. The real period is S5 to S14. How many years involved? There are 10 years involved. Therefore, I will need annuity factor of what? Annuity factor of 11% 10 years. And 11% 10 years is given 5.889. We haven't finished. And don't forget to multiply by the discount factor of the base year. And the discount factor of the base year is what? X4. And X4, that period, come here, S4, that S4 period is a nominal period. So S4, the discount factor of X4 is given as what? Let's go back, 0.592. So you need to multiply this by, so I have to multiply by the discount factor of the previous year or the base year, which is year 4, discount factor of 0.592. So these two is what I have to put there. So 5.889 times 0.592, and that is going to give me the 3.486288. When I multiply by the 32, it's giving 111.561. Sum them up and it will give you your corporate value. So please make sure you sit on this. To be honest, the difficult bit of this analysis is the C. Watch out. So you have to play within the issue of nominal and what real. So have a good look at it. Okay, and when you sum the two together, it's giving you is it 189.826, and then you take your debt value of 30, and then you go and get your equity value, which is 159.826. So this is the free cash flow principle. This is the free cash flow principle. So now let's quickly go to the next. Go and sit on it and look at the way we've done annuity, we've done perpetuity, we've done perpetuity, constant perpetuity growth and all that. Okay, so let's go straight to the next, and we're going to look at what is called duration. We're going to look at what is called duration. Okay, so let's finish the duration. We're going to be behind by just one evening. I'll bring you back because chapter number 2 is always what? Big. What is duration? Duration is coming as a result of criticisms of payback period. Duration is coming as a result of criticism of payback period. F9, you learn that payback period is the number of years the cash flows will be able to recover the investment. And payback period was criticized on the basis that it does not take into consideration the time value of money. So we brought discounted payback period. And discounted payback period measures the number of years the present values of the cash flows will be able to recover the investment. Let me bring your mind on something. Payback period, discounted payback period, will conflict with NPV because NPV is the overall profitability. So this is the meaning. Assuming I've got project A and B, I invested year 0, 100. The present values of the cash flows year 1, year 2, year 3, year 4. This is 50. This is 50. This is 10. And this is, let's say, 6. This is 20. This is 30. This is 50. This is 60. If I have to go by discounted payback period will say project A, your discounted payback period is 2 years. Project B, your discounted payback period is 3 years. So if I have to select based on the discounted payback period, it will tell me to select project what? A. If I have to calculate NPV would have told me that the total NPV of this project will be the present value of the future cash flows here, which is 66. Okay, 116 from the 100. 116 from the 100, I will get NPV of 16. If I come here, I will get NPV of 60. NPV of 60 and 16 will tell me I have to select B. So, discounted payback will conflict with NPV. And we all know our objective is to maximize the shareholders' wealth, which is consistent with the maximization of NPV. So therefore, A and B, which project are we supposed to take? We are supposed to take what? Project B, because that is what is suggested by the NPV. The common sense here is that payback or discounted payback period failed to take into consideration all the cash flows of the project. It just considers the cash flows up to the payback or discounted payback period. It doesn't consider the total profitability of the project. NPV considers the total profitability of the project, having taken into account the time value of money. Because of this criticism of the payback and the discounted payback conflicting with the NPV, that is the reason why we needed a new form of payback. And that new form of payback is what is called duration. So duration is basically measuring the payback, and is measuring the weighted average number of years the present value of all the cash flows associated with the project will be able to recover the investment, so that the discounted payback will deceive you. That duration, the duration will tell you to select will be consistent with the project NPV, will tell you to select. So we are trying to bring all other methods in line with what NPV is thinking. That is the reason why we brought internal rate of return in line with NPV thinking, and it called for the calculation of modified internal rate of return, so that there wouldn't be any conflict between NPV and any of the other methods. Same way, payback is conflicting, discounting payback is conflicting. So we need a method that will suggest for a project that will be consistent with the NPV, and that is what is called the duration. So duration is the weighted average number of years the present values of the cash flows associated with the project will be able to recover the investment. And I normally says, when they want you to calculate the weighted average is calculated as the mean, the arithmetic mean. You are calculating the average. And arithmetic mean, from our primary school learning, we learned that mean is calculated as sigma fs divided by sigma f, which is the same as your duration. So basically, when they tell you to calculate duration, you are calculating mean. So don't go and sit down and think of learning it. You know how to calculate mean in your day-to-day life. So when they tell you to calculate duration, you are calculating the weighted average, which is the same as the mean. What is the F? F here is the present value of the cash flows. And then S is the number of years. That's it. I'm not going to present it the way we did it in the note. It's just too long mathematics. And because I know some of you know how to calculate mean, for me, when you say calculate duration, I know I am going to calculate mean. And I know how to calculate mean already. So the only thing I need to know is what is the F and what is the S. In order to get my present value, these cash flows are supposed to be discounted. And there are two ways we can do that. We can discount it using internal rate of return, or we can discount it using what? Cost of capital. So when you go to the exam room, examiner should guide you as to how you should calculate the present value, either by you discounting with internal rate of return or discounting by what? The cost of capital. Okay, if the examiner don't take a stand, you take a stand. So we're going to illustrate that straightforward. Okay, don't bother yourself to go through this. No way. Duration is simply the mean. We are going to get the mean. We are going to get the mean. I don't think it's gone again because I can see myself on the monitor. So you also have to see me. Okay, so I think it should be okay. Right, so let's take this example to illustrate. Let's take this example to illustrate. Example, FCF PLC. The forecast cash flows relating to a proposed project are year 0, 1, 2, 3 up to 4 incremental cash flows. Okay, establish both the duration to recover the original investment using internal rate of return of the project of 11.13% and the duration to recover the present value of the project at 8% what? Heading rate. The heading rate is your cost of capital. So what should I advise you? Examiner might not necessarily give you this cash flow. This is the gap between lecture note and what happens in the room. Do you know how to calculate net cash flows? Sales variable cost, specific fixed cost, tax savings on capital allowance, initial investment, residual value, working capital. Then you come and get this net cash flows before you ask yourself, what method am I supposed to use? If I have to use duration, then I have to use what? Or calculate the mean. To get the present value, am I supposed to use internal rate of return or cost of capital? If the examiner has given me the cost of capital, I pick it. If he hasn't given me the cost of capital, he will expect me to go and calculate. If he hasn't given me internal rate of return, he will expect me to go and calculate. So don't expect this will be given 11.113. You go away, or 8%, you go away. He can push you, okay? He can push you to calculate those figures. How students do that interrelationship is always the problem. So given these cash flows, I have to calculate duration. What will be the duration? So be with me. This is how I'm going to calculate the duration. Simple, which you understand. So I'll say years. I've got year 1, year 2, year 3, year 4. Okay. First, my cash flows. Cash flows are given as year 1 is it 76, 16,500, 13,000, 6,600. What discount factor will you use? You either have to use the cost of capital or the internal rate of return, whichever will bring you to the same answer. So first, let's start by using internal rate of return. Question told us internal rate of return is 11.13%. I pick my calculator, 1 divided by 1.1113, and that is giving me 9 approximate. In the exam room, you can approximate it to 11%. You go. So 900 divided by 1.1113. That gives me 0.810. Press the equal sign. 729. Press the equal sign. 656. What then is the PV? I'm multiplying these two. When you multiply, you're going to get approximate 6839, 13361, 9473, 4327. This is my F and this is my X in the formula. So to get the sigma Fx, I need to multiply F by the X. This is the F and this is the X. So 1 times this will give me 6839. 2 times this, how much am I getting? 13,361 times 2 is giving 26,722. Then 3 times that, 9473 times 3 is 28,419. And 4,327 times 4 is giving 17,308. Sum them up. When you sum them up, you're going to get 6839 plus 26,722 plus 28,419 plus 17,308, and that is giving about 79288. Then if you look at the formula, is sigma Fs divided by sigma F. This is your F, so you need to sum up this. So 6839 plus 13,361 plus 9473 plus 4327. It should bring you to 34,000. As long as you discounted using the internal rate of return, the present value of the future cash flows should be equal to your initial investment for the NPV to be equal to 0 if you can apply. If you cannot apply, fine, the figures will do it for you. So my mean, which is the same as the duration, will be 79288 divided by the 34,000. And how many years is that? 79288 divided by 34,000 will give you 2.332 years. So on average, it will take me 2.332 years to recover my investment. Okay, we're going to follow the same principle for if we are discounting it at the cost of capital. So let's see the cost of capital approach. We will say years, year 1, 2, 3, and 4. What are the cash flows? cash flows here are 7,600, 16,500, 13,000, and then 6,600. What discount factor am I going to use? Now I'm using cost of capital of 8%. Get the PV, and this is my F, this is my X. Okay, so 8% will be 1.018, and that is 0.926 divided by 1.018, 0.857, 0.794, and then 0.735. Multiply 76 times 0.926. This is 6278.857 times 16,500. This is 14141.794 times 13,000 is 10322.735 times 6,600 is 4851. And what is the FX? You multiply this by 1, 6278. Okay. Unless I would have to save this before, but you can replay back and you see everything. Okay, so when you replay back, you should be able to see that. Okay, so multiply 14141 by 2, and then that is 28282. 10322 times 3, and that is 3966. 4851 times 4, and that is 19404. Sum them up. Okay, so I'm getting 16,762.78 plus 14,141 plus 10,322 plus 4851. That will give 35592. 6278 plus 28282 plus 3966 plus 19404, and that is 84930. What then is the mean, which is the same as what? The duration, and that will give you 84930 divided by 35592. So if I divide by 35592, that will give you 2.38 years. It's just approximation that is making the difference. Okay, as you might have known already, the whole lecture, I have recorded it, which you have it available. So you can go and replay that one, even if it's not this one. You can replay that one over and over, and you will see the duration. Okay, so I am going to give you a responsibility here. The responsibility is go and calculate Frederick Macaulay duration. It is calculated the same way. We are going to calculate the mean, and the mean will be calculated on the basis of what? The duration based on bonds. So Frederick Macaulay is saying if we can use normal duration to calculate the number of years the cash flows will be. You got PV of 770,374 first year. Okay, let me see. 7,600 times 0.926. Yes, it should be 70, you right? So that one will be 70,038. Okay, 70,038. So this figure will change. 70,038 plus 28,282 plus 30,966 plus 19,404. This figure will be 85,690. So if it is 85,690, 85,690 divided by 35592, duration will be about 2.4, isn't it? It will be about 2.4 there. Okay, so that is that. So let's go to the bond duration, and let me highlight. Frederick Macaulay is saying if we can use normal duration to calculate the number of years on average to recover your investment in a capital project, we can use the same principle to apply to bonds. So how do we calculate the duration of a bond? It's following the same principle. So let me take this example to illustrate. 7 years prior to the maturity of a bond with a 10% coupon. It is trading at a price of 95.01% and has a gross yield to maturity of 11.06%. Using the Macaulay duration method, calculate the bond duration. So Macaulay duration is normal duration, but we use it not for capital project like buying equipment. We use it for financial investment like buying bonds or debt. Okay, it's still the weighted average. The only difference here is that we don't separate it between cost of capital and then we don't separate it discounting using cost of capital and then internal rate of return. Why? Because the cost of the debt, if you remember from your F9, the cost of the redeemable debt is the same as the internal rate of return. So far as bonds are concerned, your internal rate of return will be the same as the cost of the bond. So you can't separate them. So that one, there is only one way. And that one way is you using the internal rate of return. So we're going to follow the same thing. What will be the number of years to redeem the bond? If it is 10 years, we're going to bring the 10 years. And then, okay, I'm going to say that modified duration relevant. I will say that. And then what will be the cash flows? Okay, so now let me do this one. And then we move on. So let's take this question because of our time here. 7 years prior to the maturity of bond with a 10% coupon, it is trading at a price of 95.01% and has a gross yield to maturity of that. How do we calculate this bond duration? So I'm going to say how many years this bond is for 7 years to go. So I am going to say year 1, 2, 3, 4, 5, 6, 7. What will be the cash flows? If you go for the bond, you are going to receive what? Cash, which will be the interest and redemption value. So interest, how much interest are you going to get on this bond? The bond is having a coupon rate of 10%. 10% interest should be a percentage based on the nominal value. Nominal value of the debt is given as percent, so it's 100. So my interest is going to be 10% of the 100, which is equals to 10. So I will have 10 every year. I will receive 10, 10, 10. But when I get to year 7, I will get the 10 plus the redemption value. If we are redeeming it at par, because this question didn't say anything, if I'm redeeming it at par, then I will redeem it and get 100 plus the interest. What discount factor am I supposed to use? I have to use the internal rate of return. The internal rate of return given to me is 11.063%. What is it? You can approximate it to 11%. So 1 divided by 1.11063, that is given 0.90 divided by 1.11063, and that is 0.811. Press the equal sign, 730, 0.657, 0.592, 0.533, and then 0.480. What will be the PV? This times that, can we say 9? This times that, can we say 8? This times that, approximately 7. This is also 7. This is approximately 6. This is approximately 6. 110 times 0.48, and that is 52.8. And what is the fx? This is my f, this is my x. So this times 1 is 9, 8 times 2, 16, 7 times 3, 21, 7 times 4, 28, 5 times 6 is 30, 6 times 6 is 36, and then 52.8 times what? 7 is 369.6. So sum up these two. If you sum up this, it should be equals to the market price. We discounted using the internal rate of return. Market price is approximately what? 95. So here, basically, we're doing it 93. And then when you sum up this, it's 9 plus 16 plus 21 plus 28 plus 30 plus 36 plus, can we say about 370, and that is giving me, let me do it again, 7 times, because of we changing this, 7 times 53 is 571. 371, so 371. So 9 plus 16 plus 21 plus 28 plus 30 plus 36 plus 371. That will give, is it 511? I think there might be a mistake somewhere, but that's fine. So my duration will be the 511 divided by the 95. Divided by 95 will give you about 5.37 years. Somebody is asking about the relevance of duration. The relevance of duration is telling you that when, for instance, I buy this bond is for 7 years. It doesn't mean it will take me 7 years to recover my money. Let me bring it to the normal base for you to understand. I have bond A. Bond A, the cash flows are year 0, 1, 2, 3, and 4. This is, I put 100. Hold everything constant. Time value of money. This is 50. This is 50. This is whatever figure. What is whatever figure? B. Year 0 is, let's say, 100. This is what? 20. This is 30. This is 40. This is whatever. Okay. Now, duration is measuring the true maturity of your money. When will you actually get your money back? These two investments are having the same redemption period of 4 years, but all of them does not mature at the same time. So if the duration of A is 2 years and duration of B is 3 years, it's telling you that A, you will take only what? 2 years to get your money back. It means your investment, the market value of bond A, you are not going to be so much about movement in interest rate in the future, because you will recover your money earlier. So when I recover my money earlier, I am not worried so much about changes in future interest rate. But if the duration of your bond is very long, it means it will take you a longer period to recover your money. And if it should take you a longer period to recover your money, you should be worried about movement in interest rate in the future. Should interest rate should be falling in the future, it will have access to the market value of the bond. So if the duration is short, the shorter the duration, the quicker you will get your money back. And as such, you are not worried about the movement of interest rate in the future. The longer the duration, you should be worried about the movement in interest rate. So in simple terms, the shorter the duration, the less sensitive the market value of the bond to changes in interest rate. The longer the duration, the more sensitive the value of your bond will be in relation to movement in what? Interest rate. So ideally, people will want bonds that will have a shorter duration in order to recoup their capital earlier, and whatever will happen in the future is going to be more or less a profit for you. So if your duration is long, you are even worried about you recovering your money early, and as such it will be very, very difficult, and then it will be sensitive to movement in interest rate in the future. So what I will say here is, when you go home, do the question on 50. When I see you next week, we're going to pick it from capital rationing. Okay, so thank you very much for your time, and any question you can send them through the email, and I'll be very happy to answer that for you. Okay, so thank you very much for your time.